If you have a business that has made you a multimillionaire on paper, welcome back to the channel because in today's video, I'm going to walk through a wealth plan for a business owner and how their business plays a role in it. If I haven't met you yet, my name is Kyle Glenn. I'm a certified financial planner and exit planning advisor at my firm, Glenn Financial, and I help business owners transition on to the next chapter of their lives while protecting what they've built. I hope that you realize this. Two business owners can have similar income, but two completely different lifetime tax experiences based off of how they structure their wealth. Two business owners can have the same taxable income and net worth, but one would have continuous tax headaches, an over concentration of wealth in their business, and an inefficient tax location, while the other understands tax implications, has a plan that addresses wealth concentration, and has a proactive strategy for each account in their portfolio. Two business owners, same numbers, completely different outcomes. What I've noticed with business owners is that the chronic busyness of their lives tend to put conversations like this on the back burner. And now that your business has made you a multimillionaire, taxes are just a cost of doing business. And there is not enough time in the day to begin thinking about something else that is not your business or your family. So problems may never get addressed. Here's a problem with that line of thinking. Not every situation is the same, and that generalization may be causing you to overpay thousands of dollars a year. You may have the exact same income as someone who is in your peer group, but if you have a plan that addresses tax efficiency, concentration of wealth, and pieces that together in an entire wealth plan for you, and not just focuses on the check that you write to the IRS, you'll be building a life that you want to live. Last year, I onboarded a hypothetical client. Let's call him Terry. Terry is 38 years old and he owns a business structured as an S corporation. He just had his business appraised to buy on a partner and it was valued at $7 million. He has roughly $100,000 in simple IRA plan established through work and $700,000 in cash in his personal bank account. He also owns a quadruplex valued at $500,000 and his personal residence valued at $425,000. From a surface level, there's not a whole lot of moving parts in Terry's picture. But the first thing that I do is take a look at the tax return because tax returns is an autopsy of what occurred in the prior year. And if it's occurred in the prior year, most likely it's occurred in years before that as well. So let's take a look at Terry's tax return. What we see here is his taxable income lands him within the 37% marginal federal tax rate. What's one big thing I noticed right away? There's $31,000 of taxable interest income. And the reason? Terry liked the peace of mind that cash provided. The problem was the significant tax bill that's attached to just that portion of his income. And year after year, Terry would be frustrated with how much in taxes he was paying. I believe that tax management is a very important thing for everyone, but especially business owners. And I break that down between tax location and tax allocation. Tax location is really a three bucket approach: taxable, pre-tax, and Roth. In other words, where are your dollars and how are they working for you? In Terry's case, his money was located in a taxable bank account and allocated to interest-bearing securities like a money market. Result: tax inefficiency. Now, there will always be a case for having cash on hand, whether to cover short-term emergencies or to have enough working capital within the business. So the argument is not, obviously, interest-bearing accounts are bad. It's more so having excess cash on hand does not provide you the peace of mind that you think it does because there is a bill attached to it. And so this is where I began to ideate a wealth plan for Terry because it's not just a balance sheet issue, it's also a cash flow problem that we have noticed through the excess tax payments that he's been given to the IRS. So now that we have a picture of Terry's tax situation, we can now look at his balance sheet and determine how it is broken down. What we see here is Terry's net worth is made up almost entirely of his business holdings. And that's not unrealistic. For Terry, his business is his fastest growing asset. What was once a business that made his family eat rice and beans, so to speak, is now a business that has made him a multimillionaire on paper. But here's the reframe that I need you to understand. Your business is a portion of your investment portfolio. And just like any concentrated position, we need to address it and have a plan for it. Take Terry, for example. He owns a $7 million business, but if we were to benchmark that to the stock market, which I understand is not a perfect comparison, that would look like a micro cap sector investment that has a great growth potential with a lot of risk associated with it, just like your business. So this is how Terry's wealth picture looked. A majority of his net worth is currently in his taxable location. That's his house, his quadruplex, and yes, his business. In his pre-tax account, he does have his retirement account through work, and he currently does not have any post-tax or Roth assets. And if you're saying to yourself, well, he should probably contribute to his pre-tax account and start building a post-tax account, you're not wrong. But currently, he can't put any money into a Roth IRA because of a rule called the pro rata rule. And what this states is that if you have assets in an IRA, like Terry does through his work plan, a backdoor Roth contribution would create a double taxation on the amount that is contributed. That's why tax location matters, especially as your income and wealth grow. So here is what we did. We gave each dollar a job and a timeline and then assigned it to an account. What we did not do is choose our favorite blend of stocks and bonds and then assign that across every account type. This strategy sounds smart, but in reality, it can leave you with higher tax bills and lower long-term growth. In the taxable section, we created an account for Terry to invest his excess dollars. We positioned assets so short-term cash lived in more tax-efficient tools such as municipal bonds or treasury bills. And long-term money moved toward low turnover equity exposure such as index funds. This creates more efficiency on a tax basis year over year. And another consideration we had was that Terry is already over concentrated in a particular sector of the market, microcap. So what we did is we decreased the allocation to that sector and overweighted in other sectors in order to try to balance that out. Now, this is not a perfect situation because his business, thankfully, is continuing to grow fast. So it does not perfectly balance this out, but it does create a path forward. In the pre-tax bucket, we moved him from an IRA plan to a 401k. Not only does that allow him to increase contributions on an annual basis, it also allows him to electively profit share, increasing the total amount deferred from current year taxation. It also avoids the pro rata rule, allowing for backdoor Roth contributions moving forward. In his pre-tax account, we allocated him to less tax-efficient investments, such as bonds and lower volatility dividend-paying funds, that if there were in a taxable account would kick off a tax bill. But because of the tax umbrella a 401k provides, there is no current taxation. The main focus here is to create a ballast for his total portfolio. Yes, this account specifically may not grow as fast due to the conservative nature of the investments, but a positive benefit of that is that it helps to mitigate risks on the downside. And here's what we did in the Roth bucket. We added growth-oriented investments once eligible, giving long-term dollars more compounding potentials. Roth IRAs are extremely powerful and they provide the most flexibility to you in retirement. Withdrawals in retirement typically do not count towards income, which may throw you into a higher tax bracket, making your Social Security taxable and your Medicare premiums increase. In the best case scenario, these are the last dollars that you would ever use, allowing the power of compounding to work on your behalf. And if you never get to use all of those dollars in that Roth IRA account, you are able to pass this on completely tax-free to the people that you choose. So for Terry, we didn't want to put bonds or low volatility dividend paying stocks in his Roth IRA. Instead, we oriented this account towards growth investments. Again, keeping in mind his already over-concentrated position in his business. So back to Terry. After building his tax plan, he now knows the tax location and tax allocation of his assets and how they will affect him on the tax level, which reduces the amount of headaches that he is experiencing on an annual basis. He has a wealth plan that addresses his concentration of wealth within his business, and each dollar in account has a specific job and utility for him. Taxable for short-term liquidity and long-term growth with low tax exposure. Pre-tax accounts as the ballast of his overall portfolio, creating stability. His post-tax Roth assets as a means for long-term growth of his money. Now that you've seen behind the scenes on where I would start from a wealth planning standpoint for my clients, I'd encourage you to look at your wealth picture with your advisor and see what specifically needs to change for you. And if you would like to have a conversation with me, click on the link below and I'd be happy to help you. Thank you so much for watching this video. I really do enjoy Thank you so much for watching this video. If you found value from it, please subscribe to the channel and hit that like button. And if you have any questions or comments, leave them in the comment section below. I'll see you in the next one.